The U.S. Federal Reserve interest rates are a constant topic in finance, directly influencing everything from mortgages to business loans. But how exactly do they impact the stock market, and should you be worried about a crash? Welcome to this Financial Explainer. We're diving deep into the Federal Reserve's powerful role in the economy and its direct connection to your investment portfolio. Market volatility often follows interest rate hikes, leading many retail investors to ask, are rising rates signaling an inevitable market crash? That's the core question we'll address today. The Federal Reserve is the central bank of the United States. Its primary tool is setting the federal funds rate, which influences borrowing costs across the entire financial system. This rate is critical for managing economic stability and controlling inflation. So how does a slight adjustment by the Fed reverberate through the massive gears of the stock market? When the Fed raises rates, borrowing becomes more expensive. This hits companies with existing debt and makes new expansion projects pricier. For consumers, higher rates mean costlier mortgages, auto loans, and credit, which often leads to less spending. Crucially, higher interest rates directly impact how analysts value stocks, particularly growth stocks. Future earnings are discounted more steeply, potentially lowering a company's perceived value today, even if their operations remain strong. To truly understand the relationship, we need to look at historical data. Let's see what the charts tell us about past rate hikes and market performance. Here is a look at historical data comparing the federal funds rate changes against the S&P 500 index. Notice the distinct cycles where rate hikes were followed by shifts in market momentum. What the charts show is that the market's reaction isn't uniform. Sometimes, the market continues to climb through moderate rate hikes, particularly if the economy is fundamentally robust. Other times, aggressive hiking combined with other economic pressures precedes a downturn. Now, let's address the elephant in the room. Does the current rising rate environment mean a devastating market crash is guaranteed? A market crash is rarely caused by interest rates alone. We must analyze a broader picture, including high inflation, unemployment rates, global geopolitical stability, and overall consumer confidence. These factors often combine to create a perfect storm. Experts agree that while rate hikes increase recession risk, they are a tool to manage overheating. The current cycle is often driven by the need to control persistent inflation, not necessarily to trigger a crash. Prudence is necessary, but panic is not. So what does this mean for you, the retail investor? How should you adapt your strategy in this environment? In a rising rate environment, it's wise to review your portfolio's sensitivity to rate hikes, ensure you are adequately diversified, and maintain a reasonable cash reserve for unexpected opportunities or downturns. Resist the urge to panic sell based on daily market noise. Focus on the long-term fundamentals of the companies you own. Consistent investing through dollar-cost averaging often proves to be the most successful strategy. To wrap up, let's revisit the key points on the Fed, interest rates, and market stability. Remember, rising rates cool the economy and impact stock valuations, but a full-blown crash requires broader systemic issues. Stay aware of the economic landscape, but don't let fear dictate your investment decisions. Thank you for watching this Financial Explainer. If you found this information valuable, please like and subscribe for more in-depth analysis designed for the retail investor. Your financial education is your best defense against market panic.